inflection point? Are we there?
Maybe. There's definitely, there appears to be a decline in the headwinds associated with Brexit and with the U.S.-China trade escalation that's created headwinds over the past year or so. I think the question that investors need to be asking themselves is what does resolution lead to?
Yeah.
Is it stabilization at a lower level of growth, or is it reacceleration? And our bet is that it's probably more like stabilization. Mm-hmm. So when you think about the distribution of outcomes over the next year or so, it still strikes me that it's pretty low odds we're going to meaningfully reaccelerate global growth over the next year or two, that the good case outcome is stabilization, and there's still a risk of further deceleration depending upon other factors beyond these two specific headwinds that we've referred to.
So Krishna, you similarly think stabilization is the watchword here, and what about some of the other risks, the geopolitical risks that as yet don't seem to be systemic, Middle East, Turkey, Syria?
Well, so I think we talk about geopolitical risk, but if you look at things, the markets are really not worried about geopolitical risks per se. What they are worried about are geopolitical risks that have significant implications for global growth. So we don't care as much about Middle East or Hong Kong or other places, but we care about Brexit and we care about the trade deal, because the implications of that are far more significant for the economy. So at the end of the day, it really comes down to, as Bob was saying, it's really about global growth. And I think global growth, in my judgment, is stabilizing. And Bob may not think it reaccelerates, but I think given the low levels where we are, there's a decent chance that 2020 ends up being meaningfully better than how 2019 shaped up.
James, give us some pushback here, because I think you yourself are a little bit more pessimistic, glass half empty on the side of where the fundamentals are showing we're going.
Yeah, the glass actually looks pretty empty rather than half empty to me, Caroline. Yeah. I'm really struggling. To me, the trade war stuff really has been an irritant as opposed to the underlying cause. I think Brexit has had a very idiosyncratic impact on business investment here in the UK. But actually, I think the bigger picture stories are really, the economy running out of road in the US, running out of capacity, running out of labour force to add, and that means that you can't keep the same pace of consumption. But really, the big story has been China and the domestic policy choice that they have made. And that they continue to make. China has been a huge demander of certain specific sectors and goods from Germany, and a lot of that has been a function of Chinese policy choices with respect to infrastructure investment, for example. And they've essentially stopped, and that means we've seen the German economy stop, and now we see the German savings rate increasing. And these things tend to feed off each other because, confidence, sentiment are the means by which, and unemployment are the means by which the cycle feeds off itself in a positive but also a negative fashion. And I just don't see any major reason why some improvement in some of these minor irritants is going to turn around the bigger oil tanker of the global economy.
An empty glass.
I think the point James is making is a very important one. At the end of the day, if there is going to be a meaningful, sustained inflection in the global economy, it'll have to come from something that China does, because the developed markets really is tapped out, and U.S. economy will stabilize, but the growth outlook is not going to get to 3% anytime soon. So that point is important. However, we also have to recognize that even in the context of China slowing down, we are still talking about 6% growth, and maybe 2020 ends up being slower than that, but it's not a catastrophic outcome. And in that context, with support from the monetary policy makers, I think the likelihood of stabilization is good, and financial asset prices in that stabilization context can do well. So if we are talking about the economy, maybe things don't work out as well as everyone expects. If we are talking about asset prices, things may work out actually better than what people expect.
Looking at asset prices and demand for certain areas of the market there, I want to look at what TLT, the ETF that tracks the longer dated bonds, has been showing us, because at the moment, money racing into it. We've got record amount of buying, open stock in terms of the ETF at the moment. So clearly there's demand for duration. Bob, what is the government bond market telling us at the moment? Is it saying we're worried about recession? Is it just saying I need some sort of yield, and it's here in the US?
I think it's telling you a couple things. One is that the Fed pivoted earlier this year, and the market has now totally underwritten that pivot and expects the Fed to continue to be reasonably dovish going forward. Two, the Treasury market relative to other large-scale developed market sovereign bonds represents by far and away the most attractive relative yield, right? So yes, the ag in the U.S. is up 8.5%, and the long maturity Treasuries are up 22%. It's going to be hard for that asset class to replicate that same rate of return over the next 10 months that they've produced over the year-to-date period, but it still behaves as a really good portfolio hedge. The correlation to risk assets remains solidly negative. I don't think that's going to change anytime soon. The factors that would change that are, an abrupt move higher in inflation, which seems unlikely, an abrupt change in monetary policy, which seems very unlikely. So for the foreseeable future, for the next year or so, I think it's really difficult to see the correlation changing. Yeah. Therefore, the expected return is not what it was 10 months ago, but it's still a really good portfolio hedge.
James, do you agree that does 60-40 still work from your perspective when we're looking at bonds and equities? Because is the hedge still working from your perspective?
Yeah, I mean, for now, I agree with Bob. I think the risk to bonds would obviously be some sort of large jump in inflation. It's very difficult to see where that's coming from just yet. I do not, by any means, believe that inflation is dead forever, and I think the fact that conversation occasionally pops up now is a sort of sign that at some stage in the not too distant future, we are going to see inflation come out of nowhere. But
even in Europe,
the bond market is telling. No, that's a very different question. But yeah, still potentially in Europe for all the wrong reasons potentially. I certainly don't think it's a function of tight labour markets reaching NERU, the sort of model that central bankers use to analyse inflation. I don't think is any use whatsoever. But if we've reached the limits of how much we can offshore production of low value-added manufacturing goods, and therefore we get an inflationary impulse from that going forward. The supply shock runs out essentially. That could be inflationary. But to me, the bond market is telling you that central banks are trapped. Essentially, economies can't generate growth without being on the monetary life support machine. And the fact that we're seeing flat curves and we're not seeing inflationary premium in markets is telling you that the mechanics of central banks cutting rates and buying bonds is great for bonds, but they don't believe there's any danger that that's going to generate inflation just yet.
Again, as usual, James is making a very important point, especially because I agree with him. The fact of the matter, though, is I think the markets, the global economy is certainly dependent on monetary policy. And one of the key things, as Bob mentioned, was the fact that the Fed pivoted. And what the government bond markets are telling you is that there's no way out. This is how things are going to be for the foreseeable future. It's not as much for returns as it is really for a hedge or for safety in case things don't work out in the equity markets more than anything else.
Can I offer a quick comment on this particular topic? I agree with the sentiment, and I think what investors should be thinking about is we have not yet seen the limit of innovation from developed market central banks. Monetary policy is not dead, in my opinion. I think think about the innovations we've seen since the crisis, right? Negative interest rates, QE, credit easing, forward guidance. I think we're going to move, over the next several years, we're going to move toward greater fiscal monetary cooperation. I think we'll eventually, in some of the large developed market economies, we're going to eventually see monetization of one form or another. And ultimately, I think we will witness helicopter money being used in a number of these economies, i.e. going direct to the economic actors in the economy as opposed to bypassing it through some form of fiscal monetary cooperation.
I think if there is a place where that is needed today, it's probably Europe. And if there is a place where it won't happen, it probably is Europe.
Difficult to execute.
Yes.
For the political issues.